Imagine you launch a fintech startup. Users are signing up, money is moving, things are looking great. Then all of a sudden, the central bank hits you with a penalty because you did not fulfill one of the regulatory obligations. It sounds ludicrous, right? But it actually happens. Hey guys, welcome back! I'm Nneoma, a corporate and tech lawyer passionate about helping startups like yourself start, scale, and grow their businesses. And that includes giving you a proper understanding of your regulatory obligations as a startup, regardless of your niche. Today, we're going to be talking about KYC AML. Now, I'm sure if you're in the fintech space or even in the financial space, whether traditional banking or the fintech startup tech era, it doesn't really matter. As long as you're in the financial space, you must have heard of these two phrases, KYC and AML. And today we're going to be breaking what those two key phrases or key abbreviations mean and what exactly startup founders must know about these phrases and how they apply to your startup and the obligations you need to fulfill. In simple terms, KYC means know your customer, your ability to know exactly who is using your platform. And AML or Anti-Money Laundering is simply you as a financial startup, as a financial company, or even in the financial industry, making sure that your company, your startup, or whatever it is, your solution platform, etc., is not being used as a medium to move shady or illegally gotten funds around. In the simplest, plainest English, that is what those terms mean. With KYC, which is know your customer, it's not merely about ticking a regulatory box that, oh, okay, I've collected some individual's data. No, it goes way beyond that. It's all about protecting your solution, your company, from fraudsters, money launderers, terrorists who would happily use your platform to pass or move illegally gotten funds if you do not check properly. And then at the end of the day, you, the company, you, the founder, would bear the responsibility of that because it's your company and you did not do your due diligence by checking up on them properly. So that is the entire basis of know your customer or KYC. So in real life, what does KYC or know your customer look like? Well, it starts with identity verification. Now, to verify someone's identity, they obviously need to submit certain documents, certain information. And for a start, or at least at the very basic tier 1 level, there are core identity toolkits that every business in the financial industry needs to collect from their users. The very first one, if you're in Nigeria, is a bank verification number. Now, every recognized adult in Nigeria has a bank verification number. This is a number prescribed by the Central Bank of Nigeria that connects all your bank accounts or financial accounts together, making it traceable to you, or connecting in all of it to you. Now, if this is the very first information you would ask any user for, especially if, again, you are in the financial space. Now, the second core identity toolkit that you ask them for is their NIN. NIN is basically your national identification number. Again, this is a number issued by the federal government of Nigeria to every citizen of Nigeria, showing that you are indeed a citizen of Nigeria. Now, typically, when a customer, a user does not have the BVN, which is very rare, but in the edge case that they don't have a BVN, the NIN will suffice. But again, it's very rare that a Nigerian citizen who is also an adult would not have a BVN. Except, of course, they've not been in Nigeria for a very, very long time, which then means they don't have any bank accounts in Nigeria, which then means, well, they have to submit the details of their resident or country of citizenship if they have dual citizenship or anything like that. Now, these two documents or these two numbers, both the bank verification number and your national identification number, they are the most important. But just in case, on the very, 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 very rare case that you do not have either of these numbers, you can submit other identification documents, such as other government issued IDs. And I know you say, well, the BVN and the NIN is a government issued ID. I know. I mean others that are not those two. For example, your international passport, the one where you travel with, everyone knows what that is, or your driver's license, or your voter's card. Any identification issued to you by the government can and most likely will suffice. Then you also have proof of address. What is something that shows that you actually do reside in the country that you say you do? So whether that can be a utility bill, a tenancy agreement signed at least within 3 months of your submission of that tenancy agreement, or even a bank statement can suffice as a proof of address. Another core identity toolkit that you need to collect as a financial company is a selfie or a liveness check. Now, anybody can submit an ID, anybody can submit a number, a BVN, NIN, whatever, anybody can submit that. But the reason or the essence of the selfie or a liveness check is to make sure that, number one, the person signing up to use your platform actually exists, and number two, that who they are, or at least their photograph, matches what is on their identification document, whether that be the BVN, the NIN, whatever it is, that their face actually matches, and that solidifies their traceability, so that should anything go wrong and you are trying to track where it went wrong from, you can easily track and identify who it is. Now that you understand the very basics of KYC and the kinds of documents or identification documents that are needed for KYC verification, you also have to understand, as a financial company or as a startup, a fintech, whatever, not all customers pose the same level of risk. For instance, a student transferring 5,000 naira, 10,000 naira, 2,000 naira to and fro to do one or two utilities within the school is a very, very, very different kind of customer from a company moving billions of naira on a monthly, daily, annual, quarterly, whatever kind of basis, right? They pose different kinds of risks. So therefore, the types of documents you would collect from the student moving 5,000 naira 10 to is vastly different from what you would collect from the company moving billions of dollars. So KYC verification is in tiered. KYC verification is tiered. Now, tier 1, basically the student or the low risk user. Tier 1 is the basic account, which is where almost everyone lives. And by almost everyone, I mean when you just log into any financial fintech solution platform, whatever it is, the first kind of account you are able to create is a tier 1 or a basic account. That basically just needs your name, your phone number, email address, and your BVN, and you are good to go. Sometimes they might not even ask for your BVN, depending on the features of that particular financial platform. They might not ask for your BVN, just put in your very basic details and you are good to go. But the issue with this is that you are only able to transact small amounts of money, which is why I called it the student account, because it basically features use of small amounts of money. And please, again, before you guys take this out of context, I didn't call it student account because only students use it. No, I just said it as an example of students that move smaller amounts of money compared to the large businesses that move billions of dollars. Now that we have that cleared up, let's move over to tier 2. Tier 2 or the medium standard account are for people that are more advanced than the basic account. They want to move more amounts of money than in the basic account. Now, typically in a tier 1 account, the transaction limit, the balance limit is it's somewhere around 50 to 100,000 naira. It never really passes 100,000 naira. It usually most often capped at 50. So if they're moving over to tier 2, obviously you know that they are moving more amounts of money, which increases to like 200,000 naira, either daily transaction wise or balance wise, or depending on, again, the features of that fintech platform or that financial platform, right? So anyone using a tier 2 medium standard account will have to drop way more documents or way more identification documents than someone in a basic tier 1 account, such as you definitely must drop your BVN, your NIN, your utility or your proof of address, which is like your utility bill, bank statements, and all of that. You need to drop all these documents minimum before you can have a tier 2 or medium standard account. And oftentimes this is where fraudsters try to move in, because why bother yourself trying to be a fraudster if you're only going to be moving 50,000 naira? Like, you might as well increase your efforts and increase your money. I'm not trying to say you should be a fraudster. I'm just saying. But anyways, so this is where fraudsters most often try to sneak in, because the amounts, again, between 200 to 500,000, depending on the features of the particular financial platform you are using. Now, if you have gone beyond 200 to 500,000 and you want to increase, whether it's your transaction limit or your banking or your balance limit, you move over to tier 3. Tier 3 is the high value account. Now, this is where the high value customers stay, whether that is a company, whether that is a politically exposed person, whether that is a celebrity, whatever it is. This tier 3 is the high value account. Typically, there is no limit in tier 3 or with a tier 3 account. There is no transaction limit, there is no balance limit. The limit basically is limited to what the bank or the financial institution can actually handle. But beyond that, for the user, there's really no limit, right? So this is for the companies, for the high flyers. And so because they are high flyers, you expect an even higher level of know your customer verification processes for them. You hold them to an even higher standard, and the regulators hold you, the company, to an even higher standard. For the high value tier 3 accounts, you first of all, non-negotiable, you need to have the BVN, the NIN, and any other core identity toolkit. You also need to have proof of address. You also need to have the biometrics or aliveness check, whether that is through a selfie, through a face verification, their fingerprint, whatever it is. You need to actually have details of their biodata, from their name, email, next of kin, and all of that good stuff. Now, this is for the individual. If it's for a company, you need to have their CSE documents, which includes the certificate of incorporation, showing that, hey, CSE or the Corporate Affairs Commission actually recognizes that this is a registered entity. You need to have their status report showing you who the directors are, who the shareholders are, whether the company is active or inactive, whether who the persons with significant control in the company is. You need to have the status report. Another CSE document of theirs or of the user that you need to have, if the user is a company, is the memorandum of association, memorandum and articles rather of association, showing you what the business can and cannot do. Very, very important, because you can see a business saying, oh, they're a pharmaceutical company, and then they are buying and selling properties. Doesn't really add up, right? How did you move from pharmaceuticals to buying and selling properties on a regular basis? Not that you were purchasing it for your usage, right? So things like that might not necessarily add up. That's why you need the memorandum of association. You also need the board resolution. Board resolution basically signifies that the directors of the companies have assented to opening a bank account with your financial institution. That is also critical. You also need the identification document of each and every director, so that each and every director is traceable. Not just collected from one director. No, you have to know who each and every director in the company is and where you can trace them to. And you're probably asking me, well, Nneoma, all of these things that you've mentioned now, how do I incorporate them into my product build? Let me walk you through it. The very first step is a pre-onboarding. Now, this is where they first get to know your app, your financial solution, or whatever, in whatever format it comes in. This is their first interaction with it. And the last thing you want to do is bombard anyone with forms. So you would ask for the most minute details or the most basic details. Example, their name, their email address, phone number, and BVN, depending on the kind of financial institution you are. The second thing you would do is to run the basic identity checks for the tier 1. This is the moment where you can now ask for the BVNs if you didn't ask for it in the pre-onboarding stage. This is also the time where you ask for their address. This is also the time where you might ask for the proof of address if you did not ask for it earlier, or if it didn't come with the basic information that they filled in. Now you're stepping up. Now you're building for tier 2 and tier 3. And this is where in your product build, you make it a priority that before anyone moves tiers, before anyone can move from a basic account in tier 1 to a standard or medium account in tier 2 to a high value account in tier 3, they must submit certain documents to pass certain verification processes. For instance, it might be a liveness check, a selfie or a liveness check. It might also be that they're submitting a government issued ID. It might also be, if it's a company, that they're submitting their CSC documents, their board resolutions, and any other kind of document that signifies either the chain of ownership or the history or the details of the beneficial owners. After you figured out the stepping up from tier 1 to 2 and then to 3, the next thing you do is to sanction and to screen your users. Now again, depending on their account type, you would know what kind of screening or sanction mechanisms to put in place. After you have implemented sanctions and screening, the next is risk allocation, risk mitigation, and or assessment. You need to understand what level of risk each user poses to your platform and treat them accordingly. So the basic account tier 1 users will not necessarily attract the same risk assessment score as the high value users that are moving billions of naira monthly, or it's not the same risk assessment or risk mitigation policies that you would implement for both parties. So you first need to design your product in such a way that they automatically recognize who is who and treat them accordingly, even in your risk allocation. Then the next obviously is corporate onboarding. If you didn't take care of corporate onboarding during your tier 2 movement from tier 1 to 2 and then to 3, if you didn't take care of it at that stage, you do need to take care of it now because it's very important. And again, they must submit all of their documents, the CSC document, board resolution, documents showing the chain of ownership if shell companies are involved, because shell companies or trust companies are the most common ways that fraudsters, money launderers, etc. move illegally gotten funds. And by the time they move it so many times, the transaction chain kind of breaks a bit, and then they clean up the money in, so to speak. After you've done the corporate onboarding, the next is to audit and monitor your users. Now, again, I'm not saying you should be peeping into their bank statements and their bank accounts and their details every waking minute. No, but at the very least, when suspicious activity happens, you need to be aware of what it is so that you can flag it on time before the regulators help you to flag it, because if they help you to flag it, well, at that point, you know that you're already liable. So save yourself the stress and audit and monitor your users. The next step in this practical product build is data protection, record keeping, encryption, because again, this is people's financial information, so it's a sensitive type of information. It's akin to like health information. They are all sensitive, so you need to take appropriate care to encrypt them, to protect them, to process them well. If you're putting them abroad, you need to take the appropriate legal steps to ensure that that data is adequately protected, so that you don't get liable for misuse or mishandling of someone's personal data. Now, what are the common mistakes that founders make when structuring their products for around KYC, or when they're even building their products, or even after they've built their products, handling it with customers or with users? What are the most common mistakes they make? Well, the very first one is collecting ID cards or collecting aliveness checks or selfies or any kind of photograph really without verifying them. You're not a filing clerk. You don't just collect files and then just keep it somewhere and leave it to gather dust. No, you are a financial institution. You ought to verify each and every document, each and every tidbit of information that you get. Verify it against the regulator databases, against any other database that exists, to make sure that they actually correlate and it's who the person says he is. The second mistake that they usually make, and this one honestly is a rookie mistake, is letting user experience win over compliance. Now, when the regulators come down on you, your users will not care how good or how bad the user experience of using your app or your platform was. The story will now turn to, oh my God, this financial company is untrustworthy. Nobody wants that. So in trying to optimize your user experience, also optimize your compliance so that you are winning on both ends. The third mistake is poor data security. Now, you can have all the KYC verification processes. Yours can even be the best in the entire industry. But if you do not protect the data that you collect very well, you can be liable for that, misuse and mishandling of someone's personal data. And again, it's financial information, so it's sensitive. Therefore, don't make the mistake of handling data poorly. The fourth mistake is ignoring beneficial owners in companies or in corporate documents. You know how I said earlier that when they give you, or when these companies submit their status report, they are the directors, they are the shareholders, and they are the persons of significant interest. Most of the times, it's not the same person or people that fill these three gaps or fill these three roles or offices. There might be different people. There might be as many as they want to be. It is your responsibility as a financial institution to get the bio data of each and every one of them, even if they are 100, but even if they are, get their data, all of them, and then protect it very well. Don't just say, oh, it's only one person that's going to be using my platform, or at the most two people, so I only need. Please don't make that mistake. If there are 100, get the bio data of all 100 of them, okay? Thank you. Now that we have covered KYC and you understand now what your obligations are with regards to KYC verification, let's move into AML, anti-money laundering, and what exactly you as a financial institution need to know about money or anti-money laundering. As I explained earlier, in very plain terms, anti-money laundering is basically you as a financial company, technology company, institution, whatever. Basically, you making sure that your company, your startup, your platform, your solution is not being used to run or move or transact with illegally gotten funds. In the plainest of terms, that is exactly what it means. But in the more sophisticated terms, AML or anti-money laundering encompasses internal controls, risk assessments and reporting procedures that financial companies must use to detect, prevent, and report financial crimes such as, again, money laundering or terrorist financing or fraud or any other financial crime that there is. Even tax evasion. It's a set of policies or principles that stop criminals, fraudsters, terrorists, launderers, etc. from using your platform again to move or to transact illegally gotten funds. Now with AML, there are certain key obligations that any financial startup or institution must have. The very first one is monitoring transactions. Now, as a financial institution, it's your responsibility to monitor transactions. Again, no, don't be creepy about it. Don't monitor them every waking minute. But you need to know when a transaction does not fit the user personality or does not fit the user profile. What do I mean by that? Imagine, again, going back to the student example. Imagine a student that is transacting 10,000 naira, 100,000 naira, 5,000 naira, but never really does, those smaller amounts. And then all of a sudden, one day, this student is moving 50 million naira. That should read as suspicious because, like, okay, where's the money coming from? How did you get it? At that moment, you should start asking questions. So monitor transactions on your platform. Step 2, your legal obligation is keep records. Keep adequate records. Let's not overflow this one. Keep adequate records, guys. Then report suspicious transactions. Once you have noticed that whatever transaction that you are doing is suspicious, it is your responsibility to report it. Another obligation is to have a compliance officer. Now, I know that most fintechs, especially those in the very early stages, will tell you, yeah, well, they don't really want to think about compliance right now. They will wait until they either get funded or they scale up or they get 1,000 users or blah, 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 yada, 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 whatever kind of English that. No. Get a compliance officer from the minute you start thinking you want to have a fintech. It's very important. It will save you a lot. It will save you a whole lot. So get yourself a financial compliance officer. Because even nowadays, CBN, NDPC rather, and all these other regulators are asking that high-value companies, even companies in certain sensitive industries, that they have compliance officers, somebody that the regulators can hold accountable in your company and say, you are the compliance officer, you knew or you ought to have known that XYZ was a regulatory obligation, so why did you not fulfill it? And as a founder, it is your responsibility. It's in the best interest of your company that you have a compliance officer, so that that person will handle the regulators and the regulations while you focus on growing your business. Another obligation with AML is that you need to screen. Again, screen your users, whether they're politically exposed, whether they're celebrities, whether they're random regular citizens. You need to screen them, understand the kind of person / company that they are, and know what their profile is, so that you can note or understand when a transaction is proven to be suspicious, so that you can also file or report it on time. Then due diligence, where you need to do it. Always do your due diligence. I can't overemphasize that one. Do your due diligence. And then train your staff. Train your staff. You can have the most sophisticated verification processes, the most sophisticated risk assessment, but if your staff in the company does not know how it all functions, doesn't know the flow, doesn't know how to flag and report suspicious activities, you're liable either way, because ignorance is not really a defense. So train your staff. But if you decide that all of these things that I've said, all of this valuable information that I have so graciously passed on to you is irrelevant to you in your financial startup, well, these are the risks that you pose to yourself. The first one is obviously the legal risk. Again, CBN, NDPA, SEC, NDIC, and other regulators can issue hefty penalties to you, your company, no matter how big or small you think you are. They can issue huge penalties to you that can collapse your business at whatever stage if you are not prepared for it. And again, rather than prepare for a penalty, why not just do the right thing? Not even just the penalties. You can even be taken to court. You can have criminal charges be charged against you, or you can have criminal charges against you. The veil can be removed, or the corporate veil can be lifted, and you, as the director, as the founder, as a shareholder, as a person with significant control in the company, will be personally liable for whatever crimes, financial crimes, the company is charged with, depending on what the crimes are. So not only are you protecting yourself as a person when you do the right thing and comply with the laws on time, you are also protecting your company. You're also protecting your reputation, because once the regulators flag you, once they issue these penalties, once they take you to court or any other thing, it automatically goes into the public eye. And once it goes into the public eye, your reputation is at stake. Right? Consumer trust that you have tried so hard to build for as many years as you've been in business is lost like that. So it costs you more to be non-compliant. So then why would you want to be non-compliant? Then there's also the operational and business risk. Most fintechs are unable, and by unable I mean they don't really have the resources at the moment that they start to be licensed themselves directly from the CBN, because it costs a lot of money. And so they usually plug into existing financial institutions and use their services as in the back end to kind of float their operation. If the financial institution, whether that's a bank, a microfinance bank, whatever it is, if they notice that your KYC, your AML practices are not up to par, they can very easily drop you as a client, or if not drop you, issue you several warnings and tell you that, hey, you need to fix X, Y, and Z. You need to fix it. Otherwise, they can either freeze your customer account, they can take you off of their directory, their user directory. They can do whatever it is to you. I mean, within the bounds of your agreement, obviously. But it's more detrimental for you to not be on par with the KYC and the AML regulations. Because if the CBN comes to flag you, they are also responsible vicariously. So it's your responsibility to protect them as well, based on the content or the terms of the agreements that you signed. There's also the investor and funding risk. Do I need to explain how this is a risk? Investors, if they find out that you are not up to par with your regulations, they can easily drop you. You could be at the very tail end of that transaction, and boom, one sniff that you are not doing the things you're supposed to do, and bam, they drop you like a hot potato. Nobody wants that. And so, to avoid all of these many risks to your business and your bank balance, here are things that you should not do, because these are mistakes that founders make, and I'm telling you these mistakes so that you do not do them. The very first mistake is waiting until investors ask about compliance. Why? Why? Like, that's just bad practice on your end. Collecting customer data without securing it. I feel like at this point, any company that does that is not really serious to be in business, doesn't really want to be in business. Because why would you collect people's data and you don't have the infrastructure to take care of it? Why? Ooh, the third mistake, my favorite, believing that you're too small for KYC AML. Let me bust your bubble real quick. Even if you're a fintech that started today, you are not too small, okay? As long as you have one user, you are not too small. As long as the first transaction has moved through your platform, you are not too small. As long as you are hooked up to whether CBN directly or to a financial institution, whether it's a bank or market, you are not too small to comply with all of your regulatory obligations. So please do so. Now that you understand KYC, AML, know your customer, and anti-money laundering regulations, God, don't let me bite my tongue. But now that you understand these terms and what they mean for you, for your startup, for your financial platform, you can clearly see that compliance is not, in fact, a luxury. It is a necessity. It is mandatory for you to have it because it protects you in the now and it secures the longevity of your business. So why would you not have it? So here's my challenge to you as a startup founder and as a company. If you have not started any compliance regulatory processes, please start it now. If you are still in the building stage, incorporate these compliance as a design in your product build. Start from the very beginning to make it easier for yourself. Start with the basics and slowly, surely build up from there. And if you don't want to think about what the basics are and how to evolve from the basics upwards, peacefully get yourself a compliance officer like me so that we can take that whole stress off of you and figure it out for you and incorporate compliance as a design into your product build so that you can reach the zenith that you as a company want to reach. Now guys, if you found this video very helpful, please hit the like button so that this video will be shared across many wonderful users like yourself that will also find it valuable and that will also share the video to many more people like themselves. Thank you so much guys for listening and for paying attention. I will see you later. Bye. Ooh, thank you Lord Jesus. I feel like I'm better at this stuff now.